Hi everyone, I am Euan Graham. I am your current DMAR chair for 2019-2020, and I'm here today with another fantastic DMAR virtual presentation. I am super excited to be joined by two members of the DMAR Market Trends Committee. I have Jill Schafer, who is our current chair of the committee, and Steve Danyliw, our past chair and current member of the committee. Thank you so much for taking the time to join us today. I am really excited to dive into all things numbers, all things trends, because I can definitely give you my perspective of what's going on currently in the market, but it's great to get the real nitty-gritty from the two of you and kind of look back at our most recent report, and I know our members are really excited to hear from you. So, let's just jump right in and get to our kind of first question. Our monthly report just came out last week. So what story do you think the report tells us about the current market and what's going on out there?
Do you want the story we try to tell or the story the media picked up? Because they're often two very different things.
Well, Jill, you tell me what story you want to tell.
My focus was on that our pendings were way up, which indicated that people were getting out there and putting things under contract again after a period of time where we either couldn't see them at all or it was very difficult to see. They were focused on that the sales were down. Well, the sales are a lagging indicator of the time period when we couldn't show anything. So it didn't surprise me, but it was happy to see how high the pendings had gone.
Steve, do you want to?
I agree. Looking at the big picture, I think we'll see that this COVID experience really was a blip on the map. It was, there were things that we're going to take away that, obviously we saw a tremendous effect. The closings in May were down, but as we expected that, you can't shut off all in-person showings for a period of time, 18 days effectively, and not have an effect on the market. So I think it demonstrated the buyers are still very strong in the market. As Jill pointed out, the pendings, properties that went under contract in May were up from April 114+%. So a big number, but it was kind of expected. Those people that were unable or unwilling to buy in April, those buyers kind of carried over into May. So they kind of joined with May's buyers, and we had a big number. So hopefully that should point us in a trajectory back to normalcy.
And I'm the one that can give anecdotal evidence, obviously being out there selling real estate day to day. And in certain price points, I'm seeing the multiple offers are back, showings galore. And it's really great to get your perspective on the actual numbers. It's like peeking behind the curtain. So how are you seeing the current sales and prices being impacted, if there is any impact?
I put a house on the market on Thursday for $475 in Country Club North, a 2-bedroom, 1-bath, half duplex. I kind of thought we were pushing the price point. I had showings set up for every hour, not overlapping, all the directions to wipe down. I had to change it to every half hour because I was getting so many agents calling saying they weren't able to get in. We ended up with 10 offers. 4 agents also called and said, is it worth it for me to put in an offer at this price? And I said, I don't want to get your hopes up, but we're way beyond that. We went under contract with a much higher than asking price with executed backup, and somebody else just sent me another backup this morning saying, I hope you haven't picked one because we sure would like to go into backup. So it was a crazy weekend, but it priced at $475, which is a very hot price range.
Yeah, then and looking at the numbers, in a larger sense, this is where sometimes we have to look at seasonality, what we normally expect to see from April to May. And when we look at prices, the average sold price, generally seasonal trends say about 1.95% increase is what we normally see this time of year. So we actually had a slight drop in average to 1.25% decrease. So in the big picture, with everything that went on, I was actually quite pleased with that. I mean, the median prices were a little bit more stable. So it kind of tells me when the averages kind of dropped like that a little bit more than median, kind of tells sometimes the higher end was probably impacted a little bit more than the lower end. And as Jill explained, certain price ranges, we're still seeing incredibly hot activity. So those are all positive things. Obviously closings took the big hit in May. We kind of anticipated that with April's numbers. The under contracts in April's were down 46% off the top of my head. Then closings in May were down a very similar number, almost 48%. So it does tell that story. We knew the closings, but if you look at the current tracking of closings, at least on a weekly basis, we're starting to get closings to start to catch up. We're not quite there yet, but catch up to the pace of last year.
And it's just kind of that, you see that perfect storm out there again with the pent-up demand for housing, especially in the Denver metro area, the lack of supply, and then interest rates being at like numbers we've never seen before. So can you, I would love for us all to be able to look into that crystal ball, but what do you, in terms of the trends, do you feel that our impact has been felt, or we're going to see some impact further down the road, or what's your thoughts there based on what we're seeing numbers wise?
Steve, you want to go first on this one?
You mentioned that famous crystal ball. It's hard to predict, what is next, what new thing that could come down the road. Could there be, quote, a second wave of COVID in the fall? No idea. But if we work under the premise of what data we see in front of us, that the curve is being flattened and that, housing is starting to recover at a very quick pace, probably the strongest segment of our economy, I think we're going to be as close to what normal looks like, within the next 30 to 60 days. I think we will be back as it was, before COVID started. And before COVID started, we were setting up for an incredibly robust spring selling season. It was going to be a record setter, but obviously was the wet blanket of COVID-19 kind of cooled that fire. So, but I think we're going to see more normal patterns, and you really won't notice a tremendous amount of issues and concerns with housing within the next 60 days.
Euan, I'm a little disappointed that you asked us to look in the crystal ball because there's not one and you can't predict. But I was asked that last year.
I just thought you had one, Jill.
Oh gosh, if I did, wouldn't that be so awesome? Because I get asked it every single month. And if I know I was asked it last year and I kind of said, this is how it's trending. But who knows? We could end up in a war. We could have some kind of, pandemic. And I know I even used the word. I hope I didn't, set us on a bad course. But who would have ever expected this? And I do think, as Steve mentioned, that we'll be bouncing back to the very strong market we were at beforehand, quick as can be. I think it's going to be a blip in the road, really.
Okay, so that's all good and well for certain price points, but have there certain segments of the market been impacted more than others? And what are you seeing, from the lower end to the luxury? What's your feedback on that?
The lower end has been crazy because we've just not had much inventory. So for a long time, we've been very, very fast moving there. During COVID, we did see some padding of the months of inventory in the luxury market. And I think we were at 9.5, correct me if I'm wrong, Steve, if you recall, for months of inventory of the detached, but we jumped up dramatically with the attached luxury market. I'm going to be curious to see what happens this next month, because I'm anxious to find out if the protests and the riots downtown will be impacting that condo market down there and what we'll see. But there's certainly a good portion of homes available that are attached above $1 million right now. That probably would be what I see as the only area that could possibly be where you might get a little bit of a deal.
Yeah, the 9.5 months for single family detached is correct for months of inventory. The big number, the number I circled when I first put eyes on the report was the luxury condo market. And that months of inventory is, or absorption rate, some people like to call it, is an important, it's an important number to track, because you're tracking, that ratio between closings and your active inventory. And the numbers, to be precise, and this is where it was really shocking. We had, at the end of month end, 151 properties for sale, priced $1 million or greater. These are attached single family homes, condos, townhomes, etc. We only closed 6. So wow. Months of inventory, little over 25. So that's, assuming no new condos come on the market at that current sales rate, it would take 25 months to absorb that current inventory. And that's a pretty impressive number. It's quite large. So again, that kind of factors back into the bigger picture that, especially when you get downtown, as Jill was mentioning, with the protesting and things like that, how that will transition to buyers looking to buy in those neighborhoods. Time will tell, but we'll probably know pretty quick in the next month or two.
So that's really great insight into that market, especially. I think I've fielded a lot of calls from past clients or people being referred to me saying they have no idea what's going on in the market. They think the market's dead if they haven't been able to get any local news or any information, because we weren't allowed to do showings. So in terms of what are the data points that your guys are tracking most closely, and what are, if you can give our members some perspective in terms of what they maybe could utilize in their listing presentations or calls with clients that they're touching base with, what is some of the feedback that you could give there in terms of specific data points that would be really resourceful for our members?
I don't know if I use specific data points as much as I just am like, we're back. I feel like we're back and moving and things are going strong. And that's kind of what I'm telling people. I am looking a lot closer on the luxury market homes and trying to analyze the statistics there. But I just think it's pretty impressive that our prices didn't change hardly at all. I mean, they came down just a tish. I'm guessing this next month they'll be back up to where they were, which was record-breaking going into COVID. So I feel like it'll be interesting to see how the inventory increases. We did see an increase in inventory this last time, which was probably people either waiting to go on the market or who'd taken it off during why have it on if you can't have showings, and we're coming back on the market.
Steve, any insight on data points?
Well, I have maybe nothing specific to the COVID environment, but generally when I look at the numbers, the first numbers I have a tendency to look at is actives and closings. I want to see what the inventory is, and I want to see what we're closing. And getting back to the discussion we just had concerning months of inventory or absorption rate, that's always a good number. If you're going to pick one number, that's always a great number to follow, because it tells you the strength of the market as far as when we're dealing with what we define as a buyer's market or a seller's market. We track those are really defined by those months of inventory. The lower the months of inventory number, the more the conditions favor the home seller. The higher the number, the conditions favor the home buyer. So, I typically look at those, to really kind of get that focus, that laser focus on, what direction things are heading. Are we trending upward or downward in those senses? There is so much seasonality in our numbers, and so it's important to understand the seasonality. When do we peak? When do we naturally drop off? And just as the term season plays, a lot of it does have to do with the interaction with our weather. The warmer it gets, the hotter the housing market. The cooler it gets, the cooler things have a tendency to happen. So we have fewer transactions and so on. So it's the seasonality is important, but the months of inventory is a very key number to follow.
So I want to definitely hit on that seasonality thing aspect that you're talking about, because I have personally, and I think the trends have seen that sometimes right at the heart of the summer, end of July, August time, we do see kind of a little slowdown, maybe in some of the transactions going on. Do you think that we're going to follow typical patterns from the last 6-7 years, where patterns have generally followed suit year over year pretty closely? Or do you think because we were impacted really March, April, we're kind of 2 months behind that, the normal, and we're going to see, a real hectic, hot summer, as you say, Steve? It's always hot here in Colorado in the summer, but what's your take on that in terms of the going into the summertime?
Well, it's definitely possible to see kind of a delayed reaction due to a disrupting event. And, the other times we've seen disruptors that affected seasonality had to do with, in 2008, we had the mortgage market meltdown, the housing bubble, that everything crashed in the financial markets. That was a major disruptor. So we saw a lot of seasonal trends kind of turned on their ear. We saw a pretty much, everybody remembers 2006, 2007, we were peaking in inventory. I mean, everybody remembers, we think it was July of 2006, we had a little over 33,000 active listings in the metro area. So that deflated. It took about 3 or 4 years to deflate after that point, but we bottomed out. And so it's, we've been in a low inventory system, but even in the low inventory environment, we've seen pretty consistent peaks and valleys. They happen every year. So a pretty good chart is one of our charts in the market trends report that kind of shows the active listings going back, I think, 2008 or 9, somewhere in there. It shows on the top part, it shows our active listings by month over that period of time, and on the bottom it shows closings. So you can clearly see that. Yeah, you can clearly see the peaks and valleys. The closings have been more consistent over the time, but you can really tell the active inventories during that mortgage meltdown and how that was greatly affected. But again, we're back in normal kind of rhythm. So we probably will see a sort of a delayed reaction to the spring selling season because we really didn't get that to happen. But I think the desire and the demand, and buyers want to buy, and we're seeing that strength. So we could definitely see a disruption this year. So generally speaking, even with inventory, we typically peak, July, August is typically when we peak in inventory. But in some years, we've gone into August before we've peaked, even into September. We've peaked in certain years. So it depends on situation. We'll probably see something happen a little later in the year as far as the seasonality trends, because this has been by any measure a pretty significant disruptor.
Yeah, I think the buyers out there that are in that, you know, what we term average price point, or really between that 400 and 600, where the most activity is, you know, I think they're all worried that we're just, you know, are they ever going to be able to buy a house? And I say, hey, hang on a minute. Like, you're getting, some people in some circumstances, we're getting interest rates below 3, which, you know, I don't feel too bad for buyers locking in rates below 3 for 30 years. But in terms of that, you know, that price point, and obviously with the inventory there and the cycle we've been on since the beginning of 2012, are we ever going to see a buyer's market again in that average price point?
That's also looking in the crystal ball.
Come on, Jill.
You keep bringing that up. But, you know, I mean, we need to see a pretty significant increase in inventory to switch back to a buyer's market in what I call not the average, but the affordable market. It may not be affordable for everybody, but it is the most affordable price range that we're really working these days. And I feel like, you know, I think it's still less than a month of inventory in a number of those price points. And so when you're looking at, because we talked about months of inventory and Steve did a great job explaining it, one of the things that I also, for people who aren't familiar with that, that, as he said, the higher the number, and really what it means is then the buyers have a lot more choices because there's more inventory in the market. When they've got more choices, they can wait. You know, they can say, oh, I saw that one, I like it, but let's see what else is out there. When there is no inventory, they've got to act fast. They've got to be pre-approved. They've got to be cash if they can. And the lower interest rate certainly helps them go up. I would have all my clients, or I've asked all my clients that are buyers to meet back up with their lender and find out what those low interest rates are doing for their budget, because it's likely going to be able to push it up, and they may be able to get in at a higher point.
Yeah, I agree. One of the things that we've also been looking at is redefining the bar, so to speak, of months of inventory. What defines, where is that threshold between what is a seller's market versus what is a buyer's market? I think traditionally we've always kind of looked at least I have, and a lot of people I've talked with, that, you know, generally that 4 to 4.5 months of inventory was kind of that balance area where, you know, once you get above that, you're talking conditions that are starting to favor the home buyer. You know, below that, the seller. But we've been in such a significant low inventory, and for so long, we're 5+ years. People are kind of start redefining that. You know, we're bringing that bar downward. So is the new, you know, anything over 3.5 months, is that considered now a buyer's market? You know, so those things, I mean, we can debate, but it's definitely being considered by a lot of people that, you know, because of the new low inventories and this being kind of the new norm, and it may be the new norm for a foreseeable point in the future, because, you know, the quality of mortgages that are being written means there's a lot fewer homes on the market that are considered distressed sales. So, you know, we go back to mid 2010, you know, 35% roughly was of what we closed each month were distressed sales, were property in some sort of financial distress, be it short sales, REOs, things like that. So we really just don't have that inventory. And for the foreseeable future, we probably won't have, even through this COVID event, we may not have that real significant increase in distressed inventory. So, you know, we probably do have to think a little bit lower in that bar as far as what defines a buyer's market versus a seller's market.
Thanks so much for that input. Yeah, it's incredible to see the market trends, especially, you know, with us and what we've gone through over the past, I really think the last 10 years, like 2011, I think, when we really hit the bottom of the market. and what the average price point was back then to what it is now. And I can remember in 2010, 2011 selling a lot of condos for $15,000, $20,000. So those days are surely over. But I want to say, thank you so much to the two of you for your insight today on this virtual presentation. But the last thing I would ask you is if there's something that you feel that is a great takeaway for the members and just a good takeaway for their business. I would love to end on something like that. So Steve, Jill, fire away.
Steve, you want to go first?
Sure. I think the takeaway is that, the last couple of months that we've gone through has taught us to be a lot more agile and nimble, and being able to just not be reactionary, even though it was very difficult not to be, but to really kind of look and focus inward on our business. And so I think some of the lessons we've learned through this will carry us, into the future. I don't think we quote have a new normal. I think at some point in the future we'll have open houses again. Not anytime soon, but I think they're going to come back at some point. But but I think we learned a lot of lessons, and we're still learning. It may not be hour by hour in some cases, but I think it's also when you're dealing with your clients. There was a lot of uncertainty, but I think with a lot of buyers and sellers out there in the market now, I think they've got their head around COVID-19 and what it means, and how to keep themselves safe. And I think that's giving them more confidence in moving forward with a real estate transaction. So I think we still need to give them guidance and security and make the transaction as safe as possible. But so I think the motivations, the motivations of buyers and sellers are high. I think they're in it with us, and they want to buy and sell.
I'll weigh in real quickly. I think for me, some of the best advice I got at the beginning of this is use that time to clean up your contact management programs, to make phone calls. You can easily make a phone call without it being about real estate now. We can say, hey, how are you doing? Did you make it through the stay at home okay? You don't even need to bring up your houses or sales. They are going to mostly say things like, yeah, we found out our house is just not good for when we're all home. We need a home office because now my husband's going to be working home permanently, or those types of things. I think you can have those conversations without having to bring it up. And I think we need to all kind of go back to some of those techniques we use. So if they don't have clients right now, that's what I would do, is just pick up the phone and just start reaching out and, checking on people real genuinely.
No, I couldn't agree more, Jill. I 100% agree on that. It's for getting back to basics. Yes, we can rely on technology, and I think we've been able to utilize technology incredibly well when showings weren't happening and things like that. But going back to the basic of just being genuinely interested in people, and that's, if we're talking about, growing our businesses and utilizing some of what positive can we take away from this is that it is that human connection. We all know as realtors, we like to connect with people, and it's that human touch that is going to separate us. So I couldn't agree with you more in terms of that. So with that being said, thank you so much. Thank you, Steve. Thank you, Jill, for taking the time out of your busy schedules to spend time with our members today. And I can't thank you enough for all the hard work. The incredible amount of hard work that the two of you put into the committee. And, I'm always sitting on the edge of my seat waiting for that report to come out every month. So thank you so much. And thanks everybody for watching and viewing. And just for more information, be sure to download the latest report, our June report, from the DMAR website. And, you know, keep an eye out for future presentations that we're going to be doing. We're just going to keep this series going. And as always, we'd love to get your insight and requests for any other presentations that you feel would be an impact to you and your business. And you can email communications@dmarrealtors.com. So thanks again, Steve and Jill. Fantastic to visit with you, and a great insight.
Thanks. You're welcome.
Thank you.